Hello folks, Charlie Gipple here, the CEO of CG Financial Group. Today I'm going to do a quick video, very quick video. This is going to be the shortest video I've ever done. This is going to be like less than 5 minutes, give or take 5 or 10 minutes here. Chronic illness riders. How is it the insurance companies get their money when it comes to chronic illness riders? Because make no mistake, the insurance companies eventually get their money with chronic illness riders, at least if those riders are activated. We hear a lot of talk, I hear a lot of talk day after day of free riders, free chronic illness riders. Well, that's not necessarily the case, and let me explain. Now, chronic illness riders, whether on term policies or, say, index universal life insurance policies, and yes, by the way, I did say term policies, life insurance, putting the life in life insurance versus just death benefits. I'm talking about living benefits on term insurance. I have in my company here represent about 6 different life insurance companies with living benefits on term policies. It's a beautiful thing. You can get access to the death benefit without having to, well, do that unpleasant thing called dying, right? So that's a great thing. Now, I digress though. What are the 3 different ways that insurance companies get their money back when it comes to providing those chronic illness riders? There are 3 primary ways. The first one, which is more of an exception to the rule than the norm, is they just charge an extra charge. They charge an extra cost of insurance charge. Again, this is more of the exception to the rule than the norm, and it may look something like this. Say you have an IUL. That IUL has a certain amount of cost of insurance charges already in it that are reducing, the consumer's cash value. That's a mortality cost of insurance charge. Well, an insurance carrier, depending on the product, if this is one of those products, here's what the insurance carrier would do. They would say, okay, but the morbidity exposure that we have, the morbidity exposure means that we're going to tack on another cost of insurance charge, a morbidity cost of insurance charge, and that will be in addition to the mortality cost of insurance charges. And if it's a death benefit focused product, what that can mean is your premiums can go up, say 5%, 10%, 15%, 20%. And many times what that also means is you have to get underwritten on the front end for that morbidity risk that the insurance company takes on. The upside is, however, and again, this is none of these are bad. None of them are the best. There is no best. It depends on the client situation. The good part to number one is when the client later has to go on claim, should they go on claim, the client knows exactly what they get cash in hand. If the death benefit is accelerated out to the tune of whatever, $20,000, that $20,000 is what the client gets cash in hand. Now, let's contrast that to the second and most popular one. The most popular way that companies charge for chronic illness riders is the discount structure. And it looks something like this. So our consumer today is age 50, and let's say at age 70, she goes on claim. At age 70, she hasn't paid anything for this rider, no additional cost of insurance charges or nothing like that. Up to this point, it has been a free rider, right? Well, at age 70, let's say that she accelerates $20,000 from the death benefit. The death benefit is reduced from $100,000 down to $80,000. What does she get cash in hand? The answer to that question is I don't know what she gets cash in hand because it's a discount structure. A discount structure that usually depends on what interest rates have done between her age 50 and age 70. A discount structure that depends on, in many cases, how severe her illness is. And then the carrier may have a few different tiers on how they're going to pay that out. But even though the death benefit may have been reduced by $20,000, she may get $15,000, $16,000 cash in hand. Is that a bad thing? No, it's not a bad thing, because either way, the carrier is going to charge, whether it's number 1, number 2, or number 3. The only bad thing about the discount structure, one of the bad things about the discount structure, which is probably about 90% of the products, is that consumer never fully knows what the total value of their policy is going to be. Well, do I get the entire $100,000 out, whether in life or in death? Because in that first scenario, the client can do that, right? And the second, they cannot. But hey, if they do not use that chronic illness rider in the second scenario, they don't lose anything, right? They haven't been charged for it. So it technically has been free if they don't use it. The third structure is this, and one of my, when I think of the type of sale that the agents that work with CG Financial Group do, I would say this is probably one that I tend to favor the best. They're all good, but I tend to favor this one. It's the lean structure, and that is between age 50 and 70 in my example. There are no additional cost of insurance charges, or I should say it differently. There are no additional cost of insurance charges, period. Now, when the client goes on claim and they reduce that death benefit by $20,000 in my example, what does that client get cash in hand? $20,000. That's another beautiful thing, right? So the death benefit was only reduced by 20, they get $20,000 cash in hand. That's great, Charlie. So up to that point, it appears that that rider is free. So is the company just doing the clients a huge favor with that product design? The answer to that question is no. The companies always get their money. How does the company get the money with that design? Well, from the point that the client goes on claim on, what happens is that death benefit is reduced by an interest rate, i.e. the lien. Think of a lien as like a loan, right? So what they took out of the policy plus an interest rate is what that death benefit is being reduced by. Which one is better? None of them are better. It just depends on the client scenario and if you can read the future on when that client will go on claim, how long they will be on claim, et cetera, et cetera, et cetera, which none of us can do. Those are the three structures: the extra charge structure, the discount structure, and third, the lien structure. Make sure you're up to speed on that. Thank you and have a good day.